Okay, now we are going to look at the first audit testing, which is test of control. Okay, under test of control, we want to test the controls are actually being implemented and exist, okay, in the business activity. Alright, because it's very important because we want to know if you have a proper control, it will prevent or detect any embezzlement, okay, misappropriations of assets. It would ensure the proper cutoff, that means the timing of how you recognize your revenue and the rest of the accounts receivable and so on. At the same time, okay, very important, we want to ensure that there will be proper allowance of uncollectible accounts, okay, because this would affect the valuations of the account receivable, which is assets in the financial position. Okay, this is example of accessions, client accessions, and what are the controls that you have, okay, in the process, business process. And in order to do the test of control, this is the procedures that we do. Okay, example, we want to ensure that the sales or the sales that in the company are actually properly occurred, exist. It's not a bogus sales transaction. So what do we do is that the invoices must be supported by the customer purchase order and also delivery document for all the invoices. That means, as I mentioned just now, the matching process, right? You will match your sales order against your delivery order and also against your invoices. Okay, so when we do test of control, we actually check the element or the information within. Okay, the name of the product, alright, the terms, the dates, and especially the quantity of the products that we have inside those documents. Okay, all must be matched. And then based on that, by right, it should be recorded in the sales revenue account. So that's where from all the documents, the matching document that we have just now, based on the invoice, we trace to the ledger. Okay, we trace to the sub-ledger. Has it been recorded in the sales account and also respectively account receivable? Okay, so that is an example of one control, and also what are the tests of control that we do. Okay, another example, for instance, you want to look at the cutoff. Okay, the objective is to ensure that, alright, the sales are being recorded in the correct period. So if let's say, remember the date of the document is very important. Alright, so if the date is all before 31st December, meaning all that document must be recorded within the accounting period of 31st December. But if let's say the date of the document is all fall in the following year, hence it should go into the following year, right? Because you have also to take note is that which document that the client use, okay, in order as a basis to recognize their revenue. Okay, because sometimes remember just now you have three documents, okay, sales order, delivery notes, and also invoices. So sometimes it's in between, especially during the year end. So sometimes in between, the timing of the documents are not within the same accounting period. So that's why it's very important to know what document do they use, right, and what are the point where they start capturing their revenue. Okay, so normally in the practice, in order to know that the internal control is actually exists, internal control are actually implemented. Okay, normally when we do the test, we actually follow certain checklists of the, call it internal control questionnaire. Okay, so in a way, we are testing the previous accessions that has already been mentioned. Okay, so for instance, like the customer order reviewed for the terms of such as price and quantity, the pre-numbered sales order are being used. Okay, so these are testing on the control of the pre-numbered. These are testing on the review process. Okay, all the credit sales approved by the credit department before shipping. So this is the approval process. Okay, so you see in every questionnaire there is a control process element that you are actually testing. Okay, so normally we check here one by one. So if the answer is yes, that means the control exists and the control are being implemented. But if the answer is no, this is where the exceptions will be gathered and will be highlighted to the management, because it is as if they claim that yes, we do have the control, but we did not practice the control. Okay, so that's why when there are exceptions, it's very crucial. Okay, this is example of an audit program. So audit program is what? Compilation of all the audit procedures. Okay, compilation of all the audit procedures. So it would actually tells you what are the steps. Remember, we are talking about reperformance. So when we reperform, we follow the steps of the audit procedures that we are actually doing. So in general, normally the steps of the audit procedures are actually in line to the flow of the activities that happen in the cycle. Okay, so this is an example. So in practice, normally in order to do that, right, if let's say your first time, right, you just join the audit firm, so you're not sure what are the audit procedures to be done and so on, so use audit program to refer. Okay, at the same time, it will ensure the standardization of the audit procedures in an audit firm. Okay, the next one is the analytical procedure. When you see analytical procedure, that means the basis is that you are comparing. Okay, alright. So in the analytical procedures, during the sales revenue, what normally you do is that you compare with the last year performance. You can also compare with the industry, okay, because you want to know what is happening in terms of sales of the company. Is it too high or is it too low or what? Because that could be the trigger point for the possible errors whatsoever. And then we also do allowances for doubtful debts and also bad debts. Okay, how much is the percentage of the bad debts from the sales? Okay, it should not be that high. It should be at least less than 5%. Okay, because we don't want to have sales, but at the end of the day, you write off. Okay, so it's like eaten up your profit that you have for that particular year. Okay, and then allowances of doubtful accounts as a percentage of gross receivable. Okay, the same thing. Doubtful means you want to you are still doubtful in terms of collecting the debts. Okay, bad debts is for you already have written off. Okay, the debts that which is uncollectible in the first place. And then when you have accounts receivable, this is the must normally, the sales days sales in accounts receivable. How many days, okay, your sales how many days actually your sales sorry, your account receivable is converted into actual sales. That means you collect the money from the customer. Okay, so by right this should be less than your credit terms that you give to your client. Okay, if it is beyond the credit terms that you give, that means there is an issue of collectability of your receivable. The same thing with the account receivable turnover. Okay, because you are comparing later on to the account analytical procedures of the for the revenue. Okay, by right it should be more or less tally. If the sales increase, in other words, your account receivable also by right should be increased. Okay, so this is where when you do the comparative, all right, between one particular year to another year. Okay, because you want to see, for instance, between 2015 and 2016, the sales increased by 9%, but between 2014 and 2015, the sales increased only by 7%. Okay, so you see between between 2 years, okay, between the years, at least you have a benchmark. Okay, now that means sales are increasing from prior years. Okay, and then the sales returns, this is where you can sometimes can see causal relationship. All right, here it shows that sales increased from 7% to 9%. All right, and then however, account receivable increased from 3% to 15%. So this is the trigger point whereby alright, whereby you are actually having and possible to have an issue of collectability. Okay, the next one you see, when you have that in mind, by right, the allowance for accounts receivable also should be higher, right? Because there is an indication that the accounts cannot be collected. But you see here, okay, the allowance for doubtful debts increased in the prior year, but last year decreased, okay, by 5.4%. So that is another way of how you see the causal relationship between one item to another item. It's like a story. Okay, if you say that the sales increase, then by right accounts receivable should increase. So the causal relationship that happened from the transactions. This is a financial ratio. Okay, when you compute, also the same thing, you want to see the pattern, okay, the trends of the company. For instance, here gross margin. So we can say that across the years, okay, their gross margin are more or less stagnant. Okay, about 27 to 28%. Right, the sales returns are also in general stable. Bad debts are also in general stable. Okay, it's just that allowance for doubtful debts are fluctuating. Okay, from 6 to 7, then from to the 6. Okay, this is number of sales receivable outstanding. Okay, so this by right is the answer is in days, 48 days. Okay, for the sales to be translated into cash. Okay, or collection. So this is where you should have compared against credit terms given to the client. Right, if let's say during the credit assessment, you give them 30 days. So in general, if everybody is 30 days, therefore your net receivable outstanding, okay, should be also more or less 30 days or less. But now if let's say above, also another indicator that lots of your receivables are having problems to be collected. Okay, so that's another reason. All right. Basically, when we do analytical procedures, right, it gives you some idea what are the possible misstatement that could happen. Okay, so that's why analytical procedures also will be helped in order to detect any possible risk of material misstatement.